Welcome to BizBeat, I'm Lily Lyu. Does a cooling inflation mean deflation risks? The answer is no. China's CPI growth for December 2020 came in 0.2%, slightly higher than expected 0%. The number bounced back in positive growth after China reported in November 2020 the first decrease in consumer price index since October 2009. The December CPI gain was minor, but still adds to proof that China is not falling into deflation. But rather, let's study the reasons behind this weak CPI streak. First, it is exactly food prices that's been dragging down the CPI. Food consumption takes up a large part of the daily consumption of the Chinese people. In November, the prices of egg and pork have resulted in a decreasing of 0.71%. What does this mean? It means that without those two price changes, the CPI growth rate could have been standing at somewhere around 0.21%. And in order to calm price fluctuations, China launched a new hog futures last week. In December, food prices were pushed up as demand goes up in holiday season. Now let's look away from food. The CPI consists of 7 other major components, including transportation and communication. Now, with the pandemic still putting restrictions on people's traveling, this sub-index was down 3.9% last November and up 0.9% in December. Some say that November's negative growth was a surprise. A look at the full-year chart could tell us that the declining trend began in July last year. One reason is that CPI in the same period 1 year ago was relatively high, hence the growth rate of CPI 1 year later will appear to be lower, and this is called the tail-raising effect. For the whole year of 2020, CPI rate stood at 2.5%, and many expect CPI to stay cool throughout the first quarter of 2021. That said, this could be good news for China's central bank, knowing that if it wishes, it has more room to conduct loose monetary policy.